Today is Monday, December 28th, 2020, and I'm your host, Max Gottlich, and we talk about my interpretations and insights into financial markets and the overall global macroeconomy. Turkey raised interest rates again to 17%, which is definitely by far the highest policy rate in a global central bank. Equities continue to post all-time highs alongside with an all-time high in margin debt, right? Investors are highly levered. In fact, just this past month, over speculators' borrowings of, against their securities, these people that are borrowing against securities, they're reached, an all-time record high of over $720 billion. So basically, also, I have to mention, I noticed a Hedgeopia article that came out the other day, and it said margin debt as a percentage of disposable income actually rose to over 4%. And that's a new high since 2 years ago, since May 2018. And this is extremely overextended. That's a very overextended move. It just proves all the more so that people are highly, highly levered against what they borrow on their securities. And the well-known United Wholesale Mortgage now offers FHA loans with rates under 2%. And these FHA loans are actually insured by the Federal Housing Administration, but through what's it called? The Conquest Loan Program, the FHA loans are actually made for home purchasers and refinances, and these guys even offer 30-year conventional mortgages with less than 2% rates. It's a first time home buyer attraction, to definitely say the least. But now, because of this, and obviously because UWM is a wholesaler, right, they themselves, right, so borrowers must pay fees, like discount points and mortgage insurance premiums and estimated finance charges of apparently almost $6,000. Um, so until borrowers realize how much they're getting screwed when they try to sell, this will continue borrowing. They will continue, you know, this borrowing action will continue from home equity lines to refinance at really, really record low interest rates. And it's just too low to ignore for the average person. And this is a reality, really, if you have a good credit and, you can actually you can actually afford a larger initial down payment or premium. But there's over 40 million Americans that need to pay back on their student loans, unless more relief will come, because the current relief ends at the end of January, I believe. And the classic 529 college savings plan is really, really hard for most middle and upper class Americans, that are attending these overpriced and overrated universities. But see, the relief only works temporarily until it expires, and borrowers on these loans will have to start paying it back, because at the end of the day, what nobody realizes is, although we live in a free country, we by no means get a free lunch. And so there's really no such thing. This is why tuition inflation is literally 5 times higher than that of CPI inflation, because, and CPI, as we know, is a fraudulent inflation metric to begin with. And because Washington redirects wealth to the already prospering parts of the economy, not the parts that actually need the reinvestment and needs these kinds of relief programs, like infrastructure that would create so many hundreds of thousands of jobs. But anyways, in other words, more people are getting poorer because more people are getting richer, right? That's the bottom line. Just quickly, I wanted to show this chart from the Financial Times because it is maybe the best representation as to how unique the challenges are today in society. But as you could see, the actual phrase "you're on mute," right, during quarterly earnings, these calls has reached record levels, right? Obviously, since the pandemic began, and Zoom saw this is when Zoom saw like an immediate 300% growth in their user base. It's very interesting to look at, and it's really interesting to fathom about. So now I wanted to take a look. I really wanted to talk about the TED spread. And I think people know what it is, but I don't think they understand its vital importance to credit risk. And that also goes for liquidity risk too. So it's essentially the spread between the 3-month T-bill and the 3-month LIBOR or LIBOR, which is the London Interbank Offered Rate, right? That's LIBOR. And since these short-term rates are primarily for overnight repo transactions or just any kind of overnight lending or borrowing transactions for these banks, again, to borrow or lend money. But we have to remember that the T-bill rate is the risk-free rate, and the LIBOR incurs credit risk that banks take when lending money to other banks. So the TED spread actually used to incorporate, euro dollar contracts instead of LIBOR, but the CME actually amended that fact, and I'm pretty sure it took after 1987 crash, and I'm not exactly sure, but this is why it's a pretty good metric for credit risk and, like I said, liquidity risk as well. And that's why it's called, TED, because it's literally an acronym for the Treasury Eurodollar rate. So a spread of it's known to, if there's a spread of 0.5 or lower, typically this suggests a pretty small amount of financial risk, right? Because but if it's over 1.0, the risk that risk becomes pretty big throughout the banking system, because banks are then charging, at that point, banks are charging a higher premium from each other on these short-term loans. So that means liquidity is shrinking. So if we check out this chart, which contains 35 years of data for the TED spread, the TED spread, and as you could clearly see in the 2008 great financial crisis, and particularly just after Lehman Brothers went bankrupt, it literally spiked to 400 basis points or 450 basis points, because the default risk on these interbank loans was increasing very, very significantly, which means investors will demand a higher rate on their loans to these other banks, and thus there will be a lower credit availability, generally speaking. So this is everything I wanted to get to for today, and I hope you enjoyed, and please like this video and subscribe to the channel if you haven't already. Please note I'm not a financial advisor, and everything I say is for educational purposes only. Thank you very much, everyone.